Welcome to Market Pulse by Orestes Capital, your daily briefing on the key market moves, sector trends, and investment themes shaping the day. Today is Friday, August 7, 2026. We're Elena and Marcus. This episode is brought to you by Bank Atlas, where the risk of every bank is quantified via proprietary grades and analysis. Learn more at bankatlas.com.
So if you look at the board today, the U.S. economy just posted its first outright job losses of the cycle. You would logically expect the market to panic.
Right, but instead the S&P 500 hit a new all-time high. So today we're unpacking why bad news just became the best news on Wall Street. Looking at today's proprietary updates, we have three major themes for you.
Theme one is a shocking negative shift in the U.S. labor market that has completely repriced global interest rate expectations.
And then theme two covers this exact bad news is good news, equity melt-up, which was really fueled by intense short squeezes in software and tech.
Correct. And finally, theme three examines a pretty stark divergence in hard assets, with gold surging on rate dynamics while crude oil plummets on Middle East geopolitical developments.
Indeed. It was definitely a session defined by sudden, violent recalibrations.
We really have to begin with the foundational macro driver of the day, which is the labor market data. This single release from the Bureau of Labor Statistics triggered the cascading moves across, well, all other asset classes we're tracking in our daily desk data.
Because if you don't understand the employment picture today, you really can't understand the equity rally. Let's get right into those numbers. July non-farm payrolls missed severely.
Right. The market was expecting a modest gain of 80,000 jobs.
Instead, we saw a loss of 23,000 jobs. This is the first time we've seen a negative print in this cycle. But looking at our data deck, it's not just one bad month in isolation, is it?
No, not at all. When you factor in the downward revisions, the underlying trend looks much weaker. The deceleration is stark, and those revisions are the real story here.
Because the previous 2 months were revised downward by a combined 103,000 jobs.
Correct. So we've gone from a narrative of massive job additions down to a 3-month average that has effectively flatlined. Looking under the hood at our internal Orestes labor market monitor, our fragility index ticked up to 52 out of 100.
And for context for the listener, this index measures the structural health of hiring trends. Anything above 45 places us firmly in a late-cycle environment where employment growth becomes highly vulnerable to external shocks.
Right, and the breadth of that hiring is cracking. Fewer than half of all domestic industries are currently adding jobs.
I mean, the private sector is limping along, adding a mere 30,000 jobs this month, while the government sector actually shed 53,000 jobs.
Which brings us to a concept we highlighted in our morning briefing, the stagflation-light tension policymakers are now facing.
That is the core dilemma. Real wage growth, meaning your paycheck adjusted for the cost of living, has turned negative again. Inflation, specifically the core personal consumption expenditures index, remains sticky at around 3.7%.
So that pace of inflation is officially outstripping pay increases. You have a rapidly cooling jobs picture colliding directly with sticky inflation. It puts the Federal Reserve in a very difficult position.
Right. Do they cut rates to save the labor market or hold rates high to fight that 3.7% inflation?
Based on the global rate reaction today, the market thinks it knows the answer. Domestic interest rates plummeted immediately after the data dropped.
The 2-year Treasury yield dropped 5.4 basis points to 4.197%.
And the 10-year yield dropped 3.6 basis points to 4.647%. This move aggressively pushed September FOMC rate hike probabilities down to just 44%.
Globally, we saw the U.S. dollar depreciate, with the DXY index down 0.36%, while the Japanese yen strengthened heavily.
The mechanics behind those yield movements are critical for any investor trying to navigate this environment. What we're witnessing is a specific yield curve dynamic.
Before we go deeper into the equity reaction, can you break down the mechanics of a bull steepening yield curve for the listener? I want to apply the first principles rule here. Why are these specific short-term and long-term yields moving at different velocities today?
Sure. Think of the yield curve like a car hitting the brakes to avoid a collision. The short-term rates, like the 2-year Treasury, represent the front of the car.
Okay.
When the market sees weak labor data, it expects the Federal Reserve to cut rates immediately, to prevent an economic stall. So the front of the car dives sharply as short-term rates fall aggressively.
And the long-term rates, the 10-year Treasury.
They represent the back of the car. They still fall because overall growth expectations are lowering, but they stay slightly more elevated because, Well, long-term inflation fears haven't completely vanished.
So the back of the car stays higher.
Exactly, so the curve steepens, because the short end drops significantly faster than the long end. It's a bull steepener because prices for these bonds are going up as their yields go down.
Moving to today's data, you would logically expect this kind of labor fracture to spark a massive sell-off in risk assets. I mean, if the economy is losing jobs, corporate earnings should eventually suffer.
But instead, we saw the exact opposite. The stock market digested this labor weakness and turned it into an equity surge.
That the S&P 500 completely shrugged off the macro data, rallying 0.62% to a record close of 7,757.64. And the equal weight S&P 500 actually outperformed the cap-weighted index, showing genuine market breadth.
Right, and the rate-sensitive Russell 2000s surged 1.0%. But the internal mechanics of that rally are what matter most. Institutional consensus and our prime brokers data showed extreme positioning leading into this morning's print.
Because non-dealers in Nasdaq futures had completely flipped to a historically extreme net short position, right?
Correct. Hedge funds and institutional speculators were betting heavily that a hot inflation or jobs print would force the Fed to hike, crushing equities.
But the jobs data came in weak, yields fell, and the market rallied against those short positions.
Exactly. When the market rallied on the prospect of rate relief, it forced a violent short squeeze. Those institutions had to buy back the stock to cover their losing short positions.
Which artificially accelerated the upward momentum.
Yes, it's a mechanical buying frenzy rather than entirely fundamental optimism.
And that mechanical buying was highly concentrated when we look at the specific corporate movers. The winners today were largely rate-sensitive growth, AI, and defense names that are successfully executing on their earnings.
Let's group these movers by theme, starting with the consumer and hardware tech side.
Airbnb surged 17.43% today, and microchip technology gained 13.89%. Both companies showed strong earnings execution, but they were given a massive tailwind by the falling yields.
Software was where we saw the most violent squeezes, though. Atlassian closed up 30%, and Twilio was up 25%.
Which makes sense. If you're holding high-growth tech companies, you have to remember that their valuations are heavily dependent on future cash flows.
Right, when interest rates drop, the discount rate applied to those future cash flows decreases, which instantly inflates their present valuation. Software relies heavily on borrowing for growth, so it acts like a coiled spring when yields drop.
We also tracked heavy momentum in the space and defense sector. Palantir, SpaceX, and Rocket Lab all rallied sharply.
But it wasn't a sea of green across the board. The losers were severely punished for fundamental misses, proving that while a short squeeze lifts the broader index, individual stock picking still matters.
Yeah, the trade desk collapsed 21.9% on an ad tech miss.
And the memory sector also provided a massive drag on the broader tech complex. Western Digital sank 20.8%, and SanDisk closed down 15.1%.
And this weakness cascaded globally. In Asian markets, the KOSPI underperformed as semiconductor hardware names sold off on broader tech sustainability concerns. Investors are really beginning to question the duration of the memory upgrade cycle.
Right.
I'm looking at this broad market rally, but there's one sector divergence in our daily desk data that stands out to me. Financials completely sat out the rally today.
Yeah, the XLF underperformed.
If a severe recession is being avoided and rates are falling, shouldn't banks be celebrating too? Why did the financial sector drop while the broader market pushed to all-time highs?
That divergence comes down to the NIM compression dynamic. NIM stands for net interest margin. When interest rates fall rapidly, particularly on the short end of the curve, it acts like a vice grip on bank profit margins.
Because banks essentially make their money on the spread between what they pay out to depositors and what they charge borrowers for loans.
Precisely. When the yield curve bull steepens and overall short-term rates drop, that profitable spread compresses. Banks can't lower the interest they pay on your savings account as fast as the yield on their new loans drops.
So despite the broad market celebrating rate relief, banks become the odd man out.
Right. Their forward earnings potential takes a direct, mechanical hit from the very same falling yields that push software stocks up 30%.
On that point, let's shift to commodities to see how this drop in the US dollar and yields impacted hard assets. We're seeing a massive divergence between metals and energy in today's proprietary updates.
If you're holding precious metals, today was a banner session. Gold surged 2.41% to $4,341.56 per ounce, and silver outperformed with a 3.28% jump.
This is mechanically driven by two factors, right? The weaker U.S. dollar and falling real yields.
Correct. Because commodities like gold are priced in U.S. dollars globally, a weaker dollar instantly makes gold cheaper for foreign buyers, driving up demand. But the more potent driver today is the drop in real yields.
Which comes back to the concept of opportunity cost. Gold yields it yields nothing. It pays no dividend and no interest.
Right. When Treasury yields are high, the opportunity cost of holding a non-yielding asset like gold is painful. You're missing out on guaranteed government returns.
But when Treasury yields drop aggressively, as they did today, that opportunity cost vanishes.
Exactly. Gold becomes far more attractive to institutional buyers seeking a safe haven that won't lose out to inflation.
Yet, looking at the energy sector, we have a completely different story playing out. Despite the broad risk-on environment across equities and metals, WTI crude fell 1.47% to $77.08 per barrel.
Which is counterintuitive.
Yeah. If the market is pricing in a soft landing and economic resilience, shouldn't oil demand be driving crude prices higher?
Normally, yes.
Huh.
But crude oil is currently captive to geopolitical risk premiums. Our daily desk data highlights reports circulating today of a potential U.S. brokered deal between Iran and Oman aimed at reopening and securing the Strait of Hormuz.
And that waterway is critical for global crude transit, so any threat there artificially inflates the price per barrel.
Exactly. For crude oil, geopolitical tension in the Middle East functions as a direct price premium. Traders price in the risk of supply disruptions.
So the moment institutional consensus sees a credible path to de-escalation and supply normalization, that risk premium is unwound immediately.
Consequently, institutional flows show U.S. energy stocks were heavily net sold today for the first time in 8 weeks. The fundamental supply-demand picture was entirely overshadowed by the geopolitical de-escalation.
Understood. We now need to connect the dots across all these data points, rates, equities, and commodities to define the broader economic regime the market is currently pricing in. Because looking at this board, it paints a very specific macroeconomic picture.
When you synthesize the simultaneous rally in treasuries, equities, gold, and credit, you're looking at a textbook Fed on hold and soft landing repricing.
The credit markets are particularly illuminating here. We saw high-yield BB and CCC spreads tightening today.
Let's unpack that for the listener. A credit spread is a difference in yield between a risky corporate bond and a safe U.S. Treasury.
So when you say BB and CCC spreads are tightening, you mean investors are demanding less of a premium to take on the risk of companies with poor credit ratings?
Yes. The tightening in BB and CCC credit is a very clear signal of economic optimism. Investors are willing to take on the risk of lower-rated, highly leveraged corporate debt because they believe lower borrowing costs, driven by the Fed stopping its rate hikes, will prevent widespread corporate defaults.
The credit market is betting that the economy will slow down just enough to lower rates, but not enough to trigger bankruptcies.
Exactly.
But I would argue the most important detail in all of this data is the inflation expectations. The 10-year break-even inflation rate held perfectly stable today at 2.25%, despite the massive rate moves elsewhere.
That break-even stability is arguably the most important signal of the entire session. A break-even rate is essentially what the bond market expects inflation to average over the next 10 years. It's derived from the yield difference between nominal treasuries and inflation-protected treasuries.
If the market genuinely feared a severe recession due to those negative 23,000 payroll numbers, inflation expectations, the break-evens would have collapsed right alongside nominal yields. Demand destruction destroys inflation.
Because they didn't collapse, the market is signaling relief that the Fed might stop hiking, rather than panic over an impending economic crash.
The data tells us the market sees a manageable slowdown, not a catastrophic cliff. It's the Goldilocks scenario, not too hot to force rate hikes, not too cold to trigger a recession.
But that Goldilocks pricing requires flawless execution from the incoming data, which brings us to a final thought for you to mull over as we head into the weekend. Today, the VIX, which acts as the market's fear gauge, dropped to a highly complacent 14.90.
We have the S&P 500 priced to perfection at all-time highs, supported by this massive short squeeze and rate relief.
But a highly anticipated July CPI print is looming next week. Are investors blindly ignoring the structural tail risk of sticky inflation colliding with a fraying labor market?
If inflation comes in hot next week and the Fed's hands are tied despite a contracting jobs market, the the complacency we see today could vanish, and the resulting volatility could pale in comparison to the squeezes we just discussed.
To quickly recap today's developments, a fractured jobs report drove a rapid drop in global interest rates. This triggered a massive institutional short squeeze in technology stocks and a surge in gold as real yields fell.
Meanwhile, geopolitical deal hopes isolated and punish the energy sector, unwinding the Middle East risk premium.
Thank you for listening to Market Pulse by Orestes Capital.
We're Elena and Marcus. We'll be back next week with the latest market color. Have a great weekend.